Hello everyone, welcome to our presentation. We will be discussing a fundamental topic in accounting, the accounting information system. Before enjoying the presentation, let me introduce myself. My name is Eka Xavier Valencia, and I'm presenting with my team, Shafa Salsabila, Assyifa Syarah, Evelyn, and Mezaluna. Enjoy!
So, what is accounting information system? Accounting information system collects and process the data and then spread the financial information to the parties to make them interest. And what is the factors that shapes the system? One is the nature of the business transaction itself, and then the size of the firm, and third is volume of the data to be handled, and lastly is the informational demands of management and others. So before we dip into the material, we should know about the basic terminology in accounting. There are many basic terminology, and the first one is even. Even is a cause, the source or cause of change in assets, liability, and equity. And even has two types. There can be external even or internal even. And we have transaction, that is the involve the transfer or exchange between two or more entities, and yes, transaction is an external event. And then we have account is a systematically arrangement that shows the effect of the transaction and other events and specific element like asset, liability, or etc. And they have and in accounting we have many account that we have to separate them into asset, liability, revenue, expense, or the capital. And next we have the real and nominal account. The real account is a permanent that contains asset, liability, quantity, and they appear on financial position. And the nominal one is the temporary account. They are revenue, expense, or dividend account, and there are on the income statement part, but except the dividend one. But companies periodically remove or close the nominal account because it's not the real account. And then we have ledger. Ledger is the book or the computer printouts that contains the account. And we have two ledger. They are general ledger that have the asset, liability, revenue, expense, and the second one is subsidiary account, a subsidiary ledger that have the detail of the account that in the general ledger. And then we have journal. Journal is the book of original entry where the company initially records transaction and selected other event. And then we have posting. Posting is the process of transferring the essential fact and figures from the book of originally entry to the ledger accounts. And then we have trial balance. Trial balance is the list of all the upon accounts in the ledger and their balances. And we have some types of trial balance. When after all adjustments have been posted is called the adjusted trial, and when is the trial balance is after closing entries is the name is post closing. And then we have adjusting entry. Adjusting entries is made at the end of the account period to bring all account up and so the company can prepare to correct the financial statements. And then we have the financial statement that contains 4 statements. One is the financial position, when the enterprise at the end of period, financial condition at the end of the period. Second one is income statement. Income statement is to measure the result of the operation during the period. Third one is statement of cash flow. It reports the cash provided and used by operating, investing, and financing activities during the period. And the last one, we have the statement of retained earnings. It's the reconciles the balance of the retained earnings account from the beginning to the end of period. And lastly, we have closing entry. Closing entry is reduce all nominal accounts to 0 and determines the transfers and the net income or net loss to an equity account. And you can see on the picture on my side, there are the debit and credit. Debit and credit didn't mean it increase or decrease. It increase, you put it in debit. When it increase, you put it in credit. No. Debit and credit is positions of when the company make entries and recording the process. And when the amount is on the left side of the account, it debits, and when the amount on the right side is credit. And we should compare the two sides. If the total debit exceeds the credit, it's the debit balance, and when the credit amount exceeds the debit, it's credit amount. And equality of debit and credit, it provides the basis for double entry system. We use double entry system now. Then we use the only one way, not the double entry. So the company records two sides of each transaction in appropriate account, and the sum of all debits must be equal to sum all of the credit. So now we're gonna talk about accounting equation. So accounting have this rumus that contains assets must be equivalent with liability plus equity, and the asset side the nominal on the asset side must be equal with the liability nominals plus the equity nominals, like the picture in my side, as you can see. So as you can see, the picture is my side. There it have the income statement, retained earnings statement, and the statement of financial position. Why these three statements connect together? It's because they have the part that can affect them all. So in income statement, we have the revenue and expense, right? When we less the revenue by expense, we got the net income or net loss. This net is gonna be used in the retained earnings statement. The retained earnings statement have the beginning retained earnings and plus it with net income or less it with net loss, and then we're gonna less it with dividend, and then we get the ending retained earnings that gonna be used in statement of financial position. Because in the statement financial position, we have the asset, liability, and equity. And in the equity, we have the retained earnings that we get from the retained earnings statement. And the equity is half the share capital as well. And the other pictures shows that relates the transaction affecting equity to the nominal or the temporary and real or the permanent classification, and to the types of business ownership. And lastly, we have accounting cycle. As you can see the picture in my side, and the company normally use this accounting procedure to record the transaction and prepare for the financial statement. And we'll see the picture. The first one is to identification and measurement of transaction and other events. And then we do the journalization and then posting, and then we do the trial balance preparation. We gonna do adjustment if we need it, and if we need the adjustment, we use the adjusted trial balance, and we have it in the worksheet. And we have the statement preparation, and that 4 statement I explained to you a while ago. And we have the closing, and then we do the post closing, and we gonna do that again and again if we need it. Thank you.
So I will explain about record and summarize basic transactions. First, there is a journaling. A company does not record transactions until ledger other events originally in the ledger. A transaction affects 2 or more accounts, each of which is in different page in the ledger. Therefore, in order to have a complete record of each transactions on other event in one place, a company uses a journal. Form in its simplest form is a general journal, chronologically lists transactions and other events, expresses in terms of debits and credits to account. Each general journal entries consist of 4 parts. First, a date. 2. The account and the amount to be debited. 3. The account and the amount to be credited. And 4. An explanation. A company enter a debit first, following by the credits, and the explanation begin below the name of the last account to include in the credited and may take 1 more lines. A company completes the ref column at the time to post their account. And the second thing is posting. The procedure of transferring journal to the ledger account is called posting. Posting involves this. First, record the date, journal page, and debit amount in the appropriate ledger account. Then, write the account number in the journal reference column. Next, record the date, journal page, and credit amount in the appropriate ledger account and write the corresponding account number in the journal reference column. Third is the COA or chart of account. This chart lists the accounts and the account numbers that identify their locations into the ledger. The numbering system that identifies the accounts usually starts with the statement of financial positions account and follows the income statement account. The range of the account number are usually like, for example, like account 101 until 199 are usually asset account, and 202 until 299 indicate liabilities. 300 until 399 indicate equity account. 400 until 499 is a revenue. 500 until 799 is expense. 800 until 899 is other revenue, and lastly 900 until 999 is other expenses. Fourth is the recording process. It starts with analyzing some transactions to know which account will be affected. So the purpose of transaction analysis is to identify type of account involved, and then to determine which is going to be a debit or a credit. We should always perform this type of analyzing before preparing a general journal, and after that we can proceed to the ledgers, and so we know the balance in every year. And the last in the basic transactions is a trial balance. So trial balance is a list of account and their balance at a given time. A company usually prepare a trial balance in the end of accounting period, or it's usually in the end of the year. So the trial balance is list the accounts in the order in which they appear in the ledger, with debit balance listed in the left column and the credit is listed in the right column. The total of the two columns must agree or balance. So a trial balance also uncovers errors in journalizing or posting in the general ledgers. In addition, it is useful in the preparation of financial statements. The procedure for preparing a trial balance consists of three elements. The first is listing the account titles and their balance. Two, totaling debit and credit column. And the last is proving the equality of the two columns.
Adjusting entry are prepared at the end of an accounting period, and they serve one of main purpose to apply the matching principle. This means we ensure that all revenue and expense are recorded in the correct period regardless of when cash change hand. So why are these adjustments necessary? Well, without them, the balance we see in trial balance may be outdated or incorrect. If we skip adjustment, we risk misstating asset, liabilities, equity, revenue, and expense on our financial statement. And when do we make the entries? Adjustment entry are prepared every single time a company create financial statement, whether they monthly, quarterly, or annual. Okay, now let's move on the first major category of adjusting entry, deferral. Deferral occur when cash changes hand before the revenue is earned or the expense is incurred. We have two types of deferral here. First, prepare expense. This is when cash is paid first. Then the concept is simple. We pay for costs in advance like supply, insurance, or even depreciation on equipment, and we initially record them as asset. But as we use them, the use proportion become an expense. The adjusting entry is like debit an expense account and credit an asset account. A common example is depreciation. We debit depreciation expense and credit accumulated depreciation. Remember, accumulated depreciation is what they call a contrast asset, the value reduced of the asset on the book. On the other side, we have unearned revenue. This is when the cash is received before any service is performed. We record this cash as liability because we still owe the customer a service. As we perform that service, the liability decreases and the revenue is earned. So the adjusting entry is debit unearned revenue and credit revenue. Okay, next we move to the second major category, accrual. Accrual are the opposite of deferral. Here, cash changes hand after the revenue is earned or the expense is incurred. First, accrue revenue. These are revenue earned from service we have already performed, but we haven't yet billed the customer or record the transaction. Common example included interest revenue, commission, fee for complete work that hasn't been invoiced. Before the adjustment, our asset, especially account receivable, and our revenue are too low. So the adjusting entry is debit on account receivable and credit a revenue account like service revenue or interest revenue. Second, accurate expense. These are expenses that have been incurred, meaning we have already used the service or received the benefit, but we haven't paid for them yet, and they haven't been recorded. Example, interest, salary, rent, or taxes. Before adjustment, both of liability and expense are understated, which is mean net income and equity is overstated. So we need to fix that. The adjustment entry is like debit the expense account and credit the payable account. For accurate interest, the calculation is multiple principal multiple by the annual interest rate multiple by the function of time that has passed. For accrued salary, they are wages employee have earned but have not yet been paid by end of period. Okay, now bad debt. What exactly are bad debts? They represent a portion of our receivable, the money customer owe us that we estimate will never be collected. To follow the matching principle, we need to record this estimated loss as an expense in the same period as the related revenue. This is done through an adjusting entry. We use contrast asset account called allowance for doubtful account. This account sits right next to account receivable on the balance sheet and reduce it to the amount we realistically expect to collect. What we call the net realizable value. The adjusting entry is debit with debt, expense, and credit allowance for doubtful account, and that's cover the main type of adjusting entry.
So after you are knowing about the adjusted trial balance, now you need to know about the financial statement. There is one income statement. Income statement contained with a revenue and expense account that you can get from adjusted trial balance. The second one, there is a retained earnings statement. This contained with one retained earning and dividend accounts that you can get from the adjusted trial balance. But you need to add the net income that you were getting from the income statement. Now, the third one, there is a statement of financial position. This statement of financial position is having an account which is an asset and liability accounts. If you having share capital ordinary account and retained earning balance, you are adding in this statement, which is statement of financial position. And where you're going to getting the asset and liability is from the adjusted trial balance, also with the share capital ordinary account, but the ending retained earnings balance is you get from retained earnings statement. So there is a closing. So closing process is the formal process in which enterprise reduce all nominal within temporary accounts to zero and transfer the net income or loss to an equity account. The first step is closing entries, which is company generally prepare closing entry only at the annual period. There is a couple question in preparing closing entries, which is one, avoid unintentionally doubling the revenue and expense balance rather than zeroing them. Second, do not close dividend to this income summary account because dividend are not expenses and not a factor in determining the net income. The second one, there is posting closing entries. This is having a purpose to close temporarily on nominal accounts and update permanent the real accounts at the end of accounting period. The balance of retained earnings represent the accumulated undistributed earnings. And what is being closed is one is revenue. The revenue is closed with the debit revenue account and with the credit income summary. Second one, close expenses with debit income summary and credit expense accounts. Third is close income summary. It's transfer the balance of the income summary to retained earnings or capital. The one before is closed dividend or drawing is with debit retained earning or capital with end. So now there is a post-closing trial balance. The post-closing trial balance is heavily proposed to prove the equality of the permanent accounts balance that the company carries forward to the next accounting period. Since all the temporary accounts have a zero balance, the post-closing trial balance will only contain permanent or real statement of financial position accounts. There is also a reversing entries, which is an optional step. So some accountants prefer to make a reversing entry at the beginning of the accounting period. A reversing entry is the exact opposite of the adjusting entry made in previous period. Use of this reversing entry is an optional bookkeeping procedure. It is not required step in accounting cycle, so it's an optional. The accountant could do it or not. It depend on their preference.
In the next slide, we will learn about the financial statement for merchandising company. The first statement is income statement. Income statement tell us if the company actually made money or lost it during the year. We start with the net sales and subtract the cost of goods sold. This is give us a gross profit, and this is basically the markup before any other expenses. And then we split the operating expense into two categories. First is selling expense like advertising, and the second one is administrative expense like rent and utilities. Totaling this up and subtracting them from our gross profit leave us with income from operation. Lastly, after adding other revenue like interest and subtracting with taxes, we get a net income of $12,200,000. Next, we move to the retained earnings statement. This is like a bridge between the income statement and the balance sheet. We start the year with $16,200, and then we add that $12,200 net income that we just calculated. Then we subtract the $2,000 in dividends, that money paid back to the owners, and then our final retained earnings for December 31st is $26,400. This amount will now move over to our next statement. Now, let's look at the statement of financial position. This is a snapshot what the company owns and owes. First one is asset. Under non-current asset, we have equipment minus its accumulated depreciation. Under current asset, the big ones are inventory, which is 40,000, and accounts receivable. Notice how we subtract the allowance for doubtful account. That's basically us being realistic about people who might not pay their bills. Second one is equity and liabilities. Here's where our retained earnings show up. When you add up the equity, the long-term bonds, and current debts like accounts payable, it's total $145,340. Finally, we must remember the golden rule, which is the asset must be same as the equity and liabilities. And as you can see, total asset is equals with the total equity and liability, and it's balanced perfectly. And finally, the next slide, we have the closing entries. Closing entries is like a resetting the scoreboard for the new year. We transfer all the revenues and expenses into a temporary account called income summary. Then we move that balance into the retained earning. Lastly, we close out the dividend account. Now, all the temporary accounts are back to zero, and we are ready to start the next fiscal year.
Thank you all for watching this presentation. We hope this presentation is useful for all of you, and bye bye.